This week on the Pete the Planner Show, we take a look at all the market volatility that has occurred in the last several market sessions. Oddly enough, it's not even the biggest news in our country right now, because what does it even mean anymore with the 24-hour news cycle? So to talk about the market volatility, I thought of one person, and I emailed him late last night. I was like, hey, I need you on the show. And he said, it's going to cost you thousands of dollars. And I said, I don't have that. Come on the show. And he said, okay, I have nothing to do. I'll be on the show. His name's Tadas, Viskanta, and he joins us now. He's the author of Abnormal Returns, which is a very popular blog on the internet in the investment sphere. Hello, Tadas.
Good to be here again. It hasn't been that long.
I know. We did our end of the year market wrap up with you. I feel like I'm going to have trouble talking today. You know what I mean? Like the words aren't coming out.
Yeah, it's one of those days.
So, Tadas, the market is sort of wigging out right now, but it feels different. It doesn't feel like a panicky, crashy sort of thing. It's what's going on?
Well, I think one of the reasons why it feels different is that last year was really unusual. Last year was unusual because it was like a magic year. The stock market went up and up with very, very little volatility and very few drawdowns. So it really didn't move a lot very much, and we didn't have any periods where it went down. And so really, I would say this year isn't the unusual year. Last year was the unusual one. And that's why this probably feels a little bit more anxious than it might.
Yeah, I had this feeling last year. There were no drawdowns.
No.
There was maybe a day or two, but it was just based on like a quarterly report here or there, which is highly unusual in the last 10 or 15 years. I think about there's almost a day a year where there's just quite a bit, or a week where there's just quite a bit of volatility, and there just wasn't in 2017.
No, it was really quite placid, and so it was like nice flat in terms of volatility. So I think that's what's really. What's kind of playing out here. And so, at least in terms of the way it feels, I think every market, I think what's going on today is, every market is unique in that sense. Today's set of circumstances, market and economy is different than last year or 10 years ago or 20 years ago. So, in that respect, everything's a little bit different. But I think we are kind of today we are kind of getting back to a more normal sort of market environment.
How much of 2017, and I guess late 2016 for that matter, isn't necessarily the Trump effect, Trump as a personality, but Trump as a deregulator? How much of the boom do you think had to do with, hey man, it's about to be a free-for-all, let's get it?
I think there is certainly an aspect to that. I think there is certainly an aspect to deregulation, and I think probably the thing we need to talk about in regards to what's happening the last month or two, it maybe has to do more with, I think people are looking at the results or the what we're seeing with the tax bill, and I think that's probably got as big an effect as anything.
Yeah, so let's talk about that, because the tax bill's done a few different things, and I was getting ready this morning. This thought occurred to me. Okay, so we've got all this market volatility. Clearly, executives at large corporations, their net worth is affected by what's going on. We saw last week, was it like the top 10 billionaires lost something like $40 billion, something just ridiculous. And I know you and I are both tearing up for them.
I think we're on the honorable mention list.
Yeah. I've lost literally tens of dollars this week. Do you think with all the, hey, $1,000 bonus here, everyone's getting raised, all this growth happening, do you think there'll be second thoughts based on what's happening to stock prices right now and how that affects the personal wealth of the leaders of these organizations that are announcing all this growth?
I don't think there's necessarily going to be second thoughts. I think what you're seeing, I think the measures that you see that have been publicly announced are quite limited, frankly. And so I don't think that those are, to me, I view those more as PR than actual having real economic impacts. And so in that regard, whatever happens with the economy over the next year or two, I don't think these CEOs are going to have second thoughts in that regard.
Can I make a clarification so that I don't get email?
Sure.
Okay.
Of course.
I'm always trying to limit my email. So when you said there's not an economic impact, what you mean is not a macroeconomic impact, as opposed to sure there'll be a financial impact on the lives of the people who receive the bonus.
Yes, of course. Anybody,
Okay.
yeah, of course.
Thank you.
Additional money in the bank is always good, and I think what most people would like to see is not necessarily, and I think this will touch on a bigger topic, is wage growth. And I think a one-time bonus is different than an ongoing increase in your pay. So kind of two different things.
Let's talk about that,
Sure.
right? And let's have an actual uncomfortable conversation. I'll be the uncomfortable part. Like every year at the end of our sort of our fiscal year, I get to evaluate. How do our business do this year? By our, I mean me and my people. You're not part of it because you wouldn't want to be, Tadas. But I had to evaluate. I'm like, okay, are we doing bonuses? How will this affect wage increases? And is the growth of our company to the point where I can do more wage increase instead of bonus? Because bonus is like, enjoy it now. Wage increase is, we're going to keep riding this thing. And, I'll be honest, I've always leaned towards bigger, much bigger than $1,000 bonuses, as opposed to huge wage growth, because there's a lot more risk in that as a business.
Sure.
And as a small business specifically. I think bigger businesses are viewing it the same way and have been for the last 2 or 3 decades with stagnant wage growth.
Yeah, no, I think everybody there, it's one thing to give a bonus. It's another thing to, I think the issue of regret comes into play. If you give people an increase in their wages, and let's say either the next year things aren't as good, that's either going to hit your profit margins, or it gets even more uncomfortable when you have a situation where you might have to right size your workforce. And I think that's one thing that corporate America really over the last 10 years has kind of come to. And I think I'll move it to a little bit of a financial angle in that regard. I think you've seen companies really use stock buybacks increasingly, almost kind of on a secular basis, because of that flexibility. You can do a stock buyback kind of whenever you want and whenever you have that cash and whenever it's kind of convenient, as opposed to, hey, let's do a dividend. Let's increase the dividend. It's very challenging to, if you decrease the dividend, that's a very bad sign to the market. And so I think CEOs have become very conscious of that and have leaned more on buybacks as opposed to dividends.
For those not in the know, let's define buyback versus the dividend situation. So a stock buyback is where a company goes back into the marketplace and brings basically equity back within the business by paying out some shareholders, right?
Correct. They're essentially buying back shares. They're taking cash taking cash out of the bank and buying shares from their shareholders, and that
in the open market.
In the open market,
yeah,
correct.
Which is important.
Yes.
Because then that drives up share prices because there's more buyers,
Correct.
Hypothetically,
and reduces the number of shares that are outstanding, which makes things like earnings per share look better.
And that is as opposed to, I can't talk. I told you, Nicole, be ready all day. It's going to be like this. To just issuing a higher dividend, because later, if things aren't as good, to lower a dividend will crush a share price.
Typically, that is typically viewed as a last resort.
Here's something I want to talk about, and I like having you on because we can hit some of the more technical stuff, right? Why? I know a student has to have asked you this. So, by the way, you're an adjunct professor at Butler University, and why does a company care what its share price is? Like, I think I want people to be able to understand why that matters, because you hear people, oh, our share price is this or that. It can't just be because they have shares in their employer. There's a deeper reason why companies want their share price higher versus lower.
Well, I think the number one reason is we have in the United States moved more towards equity compensation, and that's essentially saying that the C-suite, the CEOs and down are compensated less on cash and more on the equity that they hold or the options that they hold on those shares, and so that is a big part of their compensation. So higher share price, more higher net worth, higher compensation. So to think of it in crass terms, that's kind of the number one sort of aspect. But two, I think a higher share price, at least from a strategic perspective, gives you more options, gives you more opportunities, whether that's a merger, an acquisition, to do other sorts of projects. And I think it's also kind of, and I think the third aspect is it's kind of a scorecard.
Yeah.
You look at your share price online. Nobody looks at it in the newspaper anymore. They look
I work for a newspaper. Don't do that.
And you look at it online. You say, it's kind of your scorecard. And I think that's maybe the third aspect.
You look at Amazon, it's like around $1,400 a share, $1,370 something. Lost a ton of. We're recording this. We always got to give the context. We're recording this on Friday morning before the market opens, so
Correct.
the 9th of February. Amazon, as it continues to sort of just dominate every other industry, and it decides it wants to go into industry, and then the share price goes up 50 points. It is intimidating at $1,400 a share. Right? It's got to make its competitors, who it just constantly dominates, I don't want to say scared, but kind of scared, right?
No, I think people have dubbed it the Amazon effect. I think Amazon can, with its share price and its kind of financial might, but also its kind of technological and strategic sort of position, they can really wreak havoc in whatever sort of industry they choose to. So, and over the last couple of weeks, we heard that they are interested in messing about in healthcare. And so, it's not a coincidence that on the day that that announcement was made, that the share prices of all the big healthcare insurers fell.
And there's another story even this morning about what they're getting into, which we're going to come back and hit after the break. I think we've gone way too long. This is what happens. I get excited. Tadas Viskanta from Abnormal Returns, Butler University business professor, joins us. So more of him and a little bit of me after the break, right here on the Pete the Planner Show.
Hand on the beat. Yes, sir. Glass House. Yes, sir. Mr. Kinetic, Rusty Redenbacher. ATFU.
Back on the Pete the Planner Show. I keep wanting to call it the $1 Million Plan. It doesn't matter what the show's called. I'm Pete. There's actually if you're listening to this on the radio, there's a stinger before I start talking. Anyway, Tadas Viskanta joins us back on the show. Tadas, low point of your career being on the show, right?
No, this is the highlight of my week.
Wow, bad week, huh? Not as bad as the Colts week.
Yeah, that's a rough one. Yeah, we could talk. Yeah, this isn't sports talk, but I'm sure we could get into that if we wanted to.
All right, I got 10 seconds on it. Here's what I got. I think clearly the ethical and moral sort of fault lies in the Josh McDaniel camp. However, the poor business decision and actions lie in the Colts camp.
I think that's absolutely true, and I think the other third effect is kind of the weird NFL rules about hiring coaches that are in the playoffs, and kind of everything's on a wink and a nod until it actually happens. And so I think that's the third sort of structural thing that's going on there.
Well, I won't be asked to be in the Colts suite anytime soon with those comments, so I'm going to move on. All right, so we were talking during the break sort of what's going on with Amazon right now, which it seems in the last couple of years is always the biggest story in the stock market. This morning it was announced that they're going to start doing private business deliveries. So, pick something up from here, take it to somewhere else in town. They're going to start testing this in Los Angeles. And at the news of this, FedEx and UPS stock prices, dare I say, plummeted a little bit. They are sort of the big kid on the block, and they just do whatever they want at this point.
Bezos, I think Bezos's genius might have been, or is, or may have been, kind of doesn't care. He just kind of really has a vision for what the business is, and is willing to try things. And this thing we're discussing this morning might work, it might not, but I think they have built such a powerful engine that they really have the ability to try different things. And Whole Foods is it's kind of an interesting example of that in terms of getting into the kind of the retail food business and seeing how they're playing how they're using that as kind of an engine for other parts of the business. And I know that, Prime members can go into Whole Foods and get certain kind of deals, and I think, you can kind of see that, you can kind of see the synergy when you kind of build a big engine like that.
Now, I'm going to ask you to get your crystal ball out, but not for stock price with them.
Thank you.
I wouldn't do that to you. But what's their stock price? No. What happens from here? Do they end up being one of those companies that's going to split? I mean, I feel like splits are sort of out of fashion these days because people want high stock prices. Right. Are they going to bump into a regulatory issue where, sort of the Ma Bell, where they're too big, we got to break them up? Like, I could see that coming 10 years down the road. What do you think is going to happen?
I think that's kind of the existential threat, is that there's some sort of regulatory assault on the business. The challenge, I think, is that how do you tease it all apart? I mean, you've built, like you said, you've kind of built this huge engine, and really taking out a piston or taking out some of the spark plugs really it's not something that's, for lack of a better term, break-upable.
Yeah.
I think, AWS, which is Amazon Web Services, I think that's the one kind of logical thing where you said, okay, that could be a separate company in and of itself, and that really wouldn't have a big effect on the rest of the business. But, I'm sure they probably thought of that already, and I don't know that would really have a big effect on what we're talking about in terms of the strategic sort of potential to wreak havoc on other industries.
Weird question alert. Do your students care about this stuff? Like, I'm interested in it, but and I know they're studying it, but as a former college student, that doesn't mean you care. It just means you're studying it. Do they understand like what's going on and like how interesting times are right now in the markets, or are they just there? I mean,
I think they're pretty heads down. I think they're focused on their studies. They're focused on their internships. They're focused on potential careers down the road. I think kind of the intricacies of strategy is probably that's kind of second order sort of thinking. And I think probably not.
Do you advise I'm sure there's an investment club there at Butler, right?
They have the Student Managed Investment Fund, which is both the undergraduate and the MBAs have an opportunity to do some stock selections for that fund. So,
are you involved with that?
I used to be. I used to be an unpaid advisor to some of those groups.
Sure.
So.
Okay. Let's go back to the market in general. So, can it be said that what's actually happening right now is good, and not in sort of a trite way, but it's really that the economy's growing, inflation is a concern, interest rates are going to be going up, raising the rates. This is a good correction. It's on the verge of being a correction, but it seems like it's a good correction. It's just not fun to hear that when you're 62 years old and you're retiring in a year.
Yeah, no, corrections are never fun. I mean, I think that's one of the things that is one of the things I think is a challenge for anybody who's managing either their own money or managing somebody else's money. I think it's, we're very easily taken in by our risk profile, the risk profiles that we fill out online, or looking at a squiggly line on a chart that shows you what the stock market has done historically. And those are kind of theoretical things. And it's really when you experience it in real time with the uncertainty that that comes along with that, where you really where the rubber kind of meets the road, and you start really getting a better feel for your own risk tolerance and for what how your portfolio is structured. And I think that's where if there's anything good that comes out of this, it's kind of making those theoretical things more of a reality.
I think in some ways it's like people who claim to like spicy food, but then they have really spicy food and they're like, oh, this is too spicy. It's like, well, dude, it's spicy. I mean, so you said you liked it. There are those idiots that like I'm sorry. Those are those people who really, really like spicy food that like pour the death on their tongue. But I think a lot of times people think they've got a high risk tolerance. But Tadas, what they like is the idea of good returns. Abnormally high returns. See what I did there?
Yep.
But they don't. They don't have a high risk tolerance. They actually lack a fundamental understanding of how the market works, and that is not a cut on the individual investor. It is an observation of having done this for 20 years. People don't understand their risk tolerance.
No, absolutely, and I think, like I said, this is a learning opportunity. If nothing else, it's a learning opportunity. In some cases, it may be very well the case that you're taking on too much risk. One of my blogger friends earlier this week said, if on Monday you weren't nervous, you're not taking enough risk, and so so that may be the exception. That may be the exception to the rule. But like I said, I think this is kind of an opportunity. It's a little bit of a gut check.
Yeah, it's. I was interested this week and then last week too, because I feel like anymore when we have big drops like this, you have to question how computer trading really picks up the speed of a downtick. How much do you think that plays into it? Not in a something's wrong, but sort of just the realities of limit orders and all those sorts of things.
I think that certainly plays a role. I think the one thing that I think is really interesting is that I think the diversity of kind of, for lack of a better term, computerized strategies is probably bigger than we give it credit for. I don't think there's no one single computer strategy that's out there, which I think there's a lot of computers trading against each other. And I think to say that a drop or a rise is due to technological factors, I think is probably a little bit short-sighted. It's interesting because I was just reading a book there's a book recently about the 1987 stock market crash. And kind of the narrative there was kind of technology first kind of kicking in. And we had kind of the beginnings of computerized trading. And I think that's a situation where it really was kind of one type of strategy going on that was really sort of driving things. But I think today it's the ecosystem is far more diverse in that regard.
The last time you were on the show, we were talking about the idea that the ideal thing for someone who's maybe Nicole's age, my producer, the best thing that could happen right now is what is currently happening right now, which, and again, sounds condescending, sounds trite, but it's true. The loss or the stock prices coming down is great because then they can buy more quantity at a lower price. And so we all agree on that. But what do we say to the 64-year-old who needed to squeeze out a few more bips before they retired, and then this is their current reality? Like, you're not a financial advisor, right?
Correct.
And that's the world I come from, and I'm used to that, pep talk. But I'm just, from your perspective, what would you say to that person?
Well, I think one thing about that is that one of the great things is that people have different levers that they can push and pull and dials to turn. And so I think if your retirement was predicated upon the stock market staying where it was, then I think it's time for a reassess. It's time to reassess what it is that you're trying to accomplish. And I think that, unfortunately, I mean, I don't mean this to sound harsh, but unfortunately, there are things that, for lack of a better term, are called luck. I mean, some people, if you were retiring in 2008 and 2009, there was really nothing, there was nothing you could do about that. And so we've had 10 years, we've had a pretty long run of 10 years, and we still are where the stock market is back to where it was back in November or December of last year, not all that long ago. So in the big picture, it's not been that big of a correction at this point.
Right, and before we go to the break, that's sort of the point I wanted to get to as well, is there's no bubble bursting here. I mean, this is not 2008 where we're talking a couple different bubbles just pop, and then chaos for 6 months at least, 4 months. Let's see, October. Well, I guess who cares? It's in the past. I'm not here to talk about the past. I'm here to focus on the present. Do I sound like I'm in the baseball steroid Senate investigation now? I'm not here to focus on the past. I'm here to focus on. Let's move on. All right, Tadas, let's take a break. We're here with Tadas Viskanta from Abnormal Returns, breaking down what was a pretty crazy week in the equity markets. So we'll do that some more right after the break, right here on the Pete the Planner Show. Back on the Pete the Planner Show, the Tadas Viskanta 2018 edition. Is that a good name for the show today?
I'll take it.
Butler professor, blogger, private investor. It always says that when you read like your bio. Private investor. When do you switch to philanthropist?
Ooh, that would be cool. Wow, that'd
Yeah,
be
I think
fun.
you got to have a ton of money.
Yeah.
You know,
Yeah,
you could be a broke philanthropist because you
Yeah,
just
it
give
wouldn't
your
be-
time.
Yeah, it
You just
wouldn't-
give your
yeah,
time.
that's true. It wouldn't be as fun.
That seems like a great band, a garage band name, the Broke Philanthropist. Like just a no, maybe an album. No one cares. Okay, talking during the break because that's when the good stuff happens. Sorry, y'all. We're talking about inflation and how there are real concerns based on some of the good things happening in our economy that inflation's like right on the horizon, and we have not had inflation, any significant inflation, in at least what, a decade.
Oh, I think you're talking. I thought you're talking multi-decades.
Yeah.
I think you're talking a generation, and I think that's one of the funny things. There was an item in one of the news organizations a week ago talking about how millennial portfolio managers and traders haven't really experienced a bear market. And I think you could say the same thing for a lot of people who are running fixed income portfolios. They really haven't experienced inflation of any note. And so if you were to experience that, I think it would be not only a learning experience, but it also would be quite a shock to the system.
Inflation is one of those tricky things that not only affect people on a personal level, and sometimes they don't realize it because the cost of goods goods and services rise. But then it really infects their portfolios because of various factors. And that's why the Fed often tries to step in and control inflation to prevent us to go from where we were, in the late 70s with just, it wasn't hyperinflation, but by God, it was pretty intense, right?
Yeah, absolutely.
Also during the break, we're talking about this idea of how someone's personal finances, what you do with your investments is highly personal. I received an email this week from a woman who was early 30s, 32, 34. Not certainly the point of this. And she said, I know nothing about investing. And then she screenshotted her portfolio mix, right? Her allocation. She said, what do you think about this? And of course, there's all the disclaimers of like, I don't want to give you specific, I'll make some observations, but I'm not giving you specific advice. Okay, so Tadas, she was in an aggressive growth portfolio. So anytime someone says, I don't know anything about investing, and then you look, and then it's labeled aggressive growth, and by the way, that meant 52% international holdings. Personal finance is personal, but that also means you have to know your limits so you don't get burned. If you say, I don't know what I'm doing, that doesn't mean I'll deal with whatever comes to me. It means you have to control yourself.
No, I think that's absolutely right. I think, one of the things that I think is a challenge is that novice investors are, in a certain respect, like you said, maybe this individual as well, can be kind of swayed by either something they read or an advisor that says you need to do this, and I think that's not necessarily the case. I think that individuals have to do what's right for them, and it has to not only be right, but it also has to feel right. And like I said, this is, when the market goes down 10% in a short period of time, that really is kind of a gut check. And if for whatever reason this week has been anxiety producing, I think that is kind of a signal to take a step back and look at what's going on in your portfolio and maybe time to reassess.
I have to admit, I've cared less about this week's, what are we going to call it? Correction seems a little strong. I mean, whatever it was. I've cared less about this week's situation than I think I ever have of an event of this size. I don't know if it's because now I'm further removed from being an advisor, which, by the way, is such a great thing during these market downturns. You probably don't care either way, right? I mean, it didn't. It was just sort of conversation piece at best. It was a reason to have you on the show at best, right?
Well, like I said, I think one of the reasons is that I think people who have been watching the markets for a long time, and we kind of touched on this maybe in the first segment, this was coming. It was for whatever reason, last year was so unusual that we knew something like this was coming, and so I think this is kind of the okay. We knew this was coming, and now I think going forward is really kind of when it starts to get interesting.
It also doesn't it doesn't validate the sky is falling group either, because there's always that group that are like, oh, we are headed for tough times, and they've been saying that since April of 2009, right? Which, they're still not right, to our knowledge, because fundamentally the market is fine, and this was not a bubble. This is a byproduct of a perfect storm's again too strong, too cute, but it's a byproduct of some good things happening, and I think that's why I care less more than ever about this.
Yeah, no, it's hard. It's hard to point to any one thing where you say, "Wow, this is really out of whack." I think the really odd stuff has been happening outside of the stock market. I think the entire cryptocurrency phenomenon has really been the weird aspect to what's happened in the last year or two. And I think the stock market has really been, like we said, has been. I don't want to use the term rational, but it's kind of been somewhat orderly.
The old irrational exuberance there for you. I'm currently seeking stability within the cryptos markets right myself. Can I give an update on, remember when I bought crypto live on the air? Tadas, this was not a good thing, but I all told, I'm down 10% from buying crypto on the air. I was up 100% at one point, but I'm currently down 10%. And when did I buy that, Nicole? November? Does that sound about right?
You bought that right before Christmas.
Oh, okay. Right?
It's pretty good.
Up 100%, now down 10. That's so stupid. I mean, this is really dumb.
Yeah, but I think we talked about it during the year-end wrap-up. It really is kind of. It's kind of like playing the market on steroids. I mean, you really you get a sense for what markets can do both on the upside and the downside really quickly when it comes to Bitcoin or other cryptocurrencies.
I've fallen out of love with the volatility of it. Like, I really have. And by the way, it's really I don't want to say it's stabilized, but it hasn't been as volatile recently. But I think the worst part about crypto for me is I'm so annoyed by the fanboys of crypto. There's people on social media that they just talk up crypto, so you'll get in crypto so that the price will go up. And it's just like, fundamentally, I have a lot of problems with it. Let's do this. Let's take a break, final break. Come back. We'll do the biggest waste of money of the week. I'll make Tadas think of one during the break. If he can't think of one, I've always got a waste of money on hand. So Tadas Viskanta, professor at Butler University, as well as author and editor, and Svengali at abnormalreturns.com. So we'll be right back. I'm Pete the Planner.
Axe hand on the beat. Yes, sir. Glass house. Yes, sir. Mr. Kinetic, Rusty Redenbacher. ATFU.
Back on the $1 Million Plan, the biggest waste of money of the week. I'm going to take this one, Tadas.
Go for it.
Tadas Viskanta is back with us. You can see us at PeteThePlanner.tv. Got a new angle on the camera. Nicole, I don't know if I'm feeling it. Like, I feel like my Jabba chin is really...
Your Jabba chin?
Like, I feel like I have no definition of my chin, which maybe I don't.
I think you're being silly, but
Well.
I understand.
All right. This week's BWOM, biggest waste of money of the week. The North Face Geodome 4 tent. Leveraging the strength of the geodesic dome.
Geodesic.
Jeez. Smart guy. Geodesic dome. You should be here all the time. The North Face Geodome 410 is a roomy shelter able to handle tough conditions. It sleeps 4 and has enough room for you to stand inside, yet consists of only 5 main poles and 1 equator pole, making it both lightweight and easy to set up. It can also withstand winds of nearly 60 miles per hour, thanks in part to its dual-layer, water-resistant exterior, but unfortunately, Tadas, it's exclusive to Japan for now, and it costs $1,650. Here's why it's the biggest waste of money of the week. If you're in a situation in which there is even the slightest possibility that there's going to be a 60-mile-per-hour wind, stay inside.
I think that's good advice.
I mean, we're going to test the limits of this thing this week. No, you will die.
Do they do it in a wind tunnel?
I don't know. Like, they had people camping in a wind tunnel.
Yeah.
I've always wanted to go in. You got such good hair. I bet if you went in a wind tunnel, you would look like a model.
Well, I like to lock it down, so hopefully it doesn't move too much, unlike the president's hair.
Did you see that?
Yeah, that was interesting.
He was getting on Air Force One, He was going in the back door of Air Force One, it looked like, from that angle. I don't know.
And they've been working on it. They're swapping out the refrigerators.
How much was that? What was that crazy refrigerator? Like $28 million for a refrigerator or something?
Those are.
That's the least of our problems right now. All right. Thanks for being on the show.
It's my pleasure.
If people want to enjoy your brilliance, what's the best way? Enroll at Butler? Like, what do they need to do?
Well, that's a little pricey. Abnormalreturns.com is free, and so you can go there, sign up for the email. You get an email from me every day.
Oh my gosh!
If you want to go on to Twitter, then @abnormalreturns. Easy peasy.
Easy peasy, lemon squeezy is, I believe, what they say. Geodesic? What does that mean?
I'm not exactly sure.
But you know how to say it?
I know how to pronounce it, yeah. Buckminster Fuller.
Yeah, there you go. All right, everybody. That's it for the show. If you want to be on our show, you can't be on this one, unless you're Tadas. If you want to be on our podcast, you can. Go to PeteThePlanner.com/podcast. You can always watch the show and see my weird chin situation at PeteThePlanner.tv. Go to AbnormalReturns.com. That's it. Send you good vibes, because good vibes are all that we have in the budget. I'm Pete the Planner, and this is the Pete the Planner Show.
This is where I came from. Planet Lovetron, where we drop love bombs, funk missiles, and live in soul shelters. No helter skelter. The heat don't swelter because everybody stays cool. Left many moons ago to bring the philosophies of my ancestors to another place. God picked the third rock, gave me to my earth family, and told me to create. And so I am. Pen in my hand, microphone on the stand. Over vinyl, I command and demand. Magnificence in an instance, I can make you dance, cry, or love. Fly as a dove, released from Everest. The fresh is fresh, and you can call me E.T. Word to John Tesh. Let me bless this harmonic presentation. It's amazing, so amazing. I'm the reason. Salutations, I bring you Lovetron greetings from a faraway land. I am the sole controller. Put the remote down and let me take control. You're now a part of my zone, so enjoy yourself. Lovetron can restore your health. I bring you greetings, salutations. How you doing? And is that how y'all say it? The tinkling of the keys is an homage to the little star. I sojourn over poetic descriptions of sound to travel to my other world. Out of this world, spaceship on my arm took me home, fueled by the ink and the megabytes and the hypertext transfer protocol, stronger than the Skynet and the Terminator. I push faders into warp speed, glide with